You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson from WallStreetWindow.com. Welcome to the show, Mike.
Oh, thanks for having me.
What I want to know is, with so many people telling us the equity markets are at their peak, why are people still throwing their money in there?
Well, what happens to the public generally is two things. The way they understand the market is through their experience with the stock market. So what tends to happen is they react to the last couple years of what's happened and then expect it to go on forever. And if something really unusual has happened during that time, then they really get impacted by that. For example, you sometimes hear people talk of a 20% rule in the stock market, where if the stock market were to decline 20%, that means you're in a bear market. Well, what happens to people is that 20%, they see stuff fall 20%, they lose money, then they say, oh, we're in a bear market, and they start selling, and so forth. And it can take 6 months to 12 months for that 20% loss to take place. But most bear markets, they fall about 30%. So by the time they figure out you're in a bear market and they start selling, it's pretty much silly. They might as well just hold and ride out the remaining couple months or whatever, usually. But what happens to them is, after that realization that, oh, we're in a bear market because we've fallen 20%, even if the market bottoms and starts to go back up, they still believe they're in a bear market and still feel like they're in one because they've experienced all this pain. So what happened, what the statistics show, is that, we had a crash in 2008 in the stock market in the United States, then another move lower in March, and the statistics show that most people actually rode out the crash. Very few people knew to get out beforehand, simply because they don't understand how to read markets. They just go by this gut experience I'm describing. But what happened was the statistics show that people continued to sell once the market turned around in 2009 and 2010 and 2011. Americans actually put more money out of their stock funds than they put in during those years. And then in 2012, all of a sudden, they started to buy back into the market. And last month, interestingly enough, they bought more stocks in any given month than any time in the past couple of years. So what I want to suggest to you, to answer your question, is to flip around the bear market feelings people get and just think about bull markets. So what I just told you is people were skeptical and scared of this market until 2012, and then they started to get excited, and now they're so excited they're throwing their money at it. What has happened is they're reacting to the past couple of years of seeing the market go up with the idea or thought now that it's going to go up forever. They don't look at fundamentals. They don't look at valuations. They don't look at charts. They just go by their experience. So even though there are experts pointing this thing out that's dangerous or that thing out that's dangerous, and I must say I am one of these people, the general public is completely oblivious, and they're not really going to listen because they just go by their experience, and that's all they know. And they don't really understand how to look at things in the market, and are as a whole unwilling to do the work to educate themselves, read a couple books, just anything. It's like they don't really know what they're doing, unfortunately.
Well, with so many people not being experts in this, how come they ignore the chance to, say, subscribe to your newsletter to find out what's going out there? Obviously, you're an expert. You make money doing this. You know what you're talking about. Why do they ignore people like you?
Well, yeah, I just think for most people, I mean, it does take some time and motivation to want to read. They would have to buy my stuff and read it, and that takes time. And people are very busy with their daily lives, and it kind of has to be something you really want to apply yourself to and work at. And I just think most people are either too busy or too lazy to do that. And most people just entrust their money and just hope it goes up. I mean, they just buy a couple of mutual funds and just figure, well, these people running the funds know what they're doing, and I'll just trust them. But the problem is mutual funds, they don't really, as a whole, ever try to time the market or adjust for risk. Their job is not to invest all your money. Their job actually is to invest the money you give them into the stock market and buy stocks at all times. So that's what they do. But, you know, it's just not me. I mean, there's other people on tap, you know, other books, people write books. You have plenty of guests on your show. You know, it's too bad the whole world isn't listening to your show.
I mean, the old saying, buy low, sell high. How come I would say 80% of people ignore that? They buy high and then panic and sell low.
Well, it's just what I was describing earlier. They just kind of, by going by, you know, only what they're experiencing and not really planning ahead, they end up being behind the curve and chasing markets. So, I mean, what's interesting is if you look at the U.S. stock market, the NASDAQ hit 5,000 twice in the past 6 weeks, and both times that it did it, it only stayed above those levels for a few moments. For the first time, 3 hours, the second time for 3 days. But when it did it, there was tremendous excitement on the financial media. And if you watched it, you got the impression that on that day, all this money was just being made and fortunes were being built in the stock market and anyone in it. But in reality, all the gains really came years ago. You know, it took 6 years for the stock market to get, for the NASDAQ to get to 5,000. So, and most of those gains in a bull market actually come in the first third of it. So right now, in fact, because we're so late into the game in this market, it's almost barely up year to date. I don't even know if it's up 1% as we're speaking, the S&P 500. So despite all the excitement, you got to ask people, are you making money this year? And most people really aren't. A lot of people are probably even, you know, most people are going to be barely up or barely down, and their results do not back up the thrill and excitement they're seeing on the TV. And it's not, and there's another reason for this too, and that is the stock market is not really reflecting the fundamentals of the economy. It just isn't, you know. The NASDAQ may have gone to 5,000, but there's no economic boom going on in the United States. In fact, they just had to downgrade the first quarter GDP numbers from 3% down to 0.2%, which might as well be a recession. I mean, that's just an incredible downgrade of growth. And if you say to yourself, well, there's two things to take away from that. One, well, which is what they're saying on the TV for the most part, is, well, economic data doesn't matter. We have the Fed, and they just make it go up forever. And this is kind of like some sort of investment wonderland. But, you know, at some point, you may want to also ask yourself, why is this happening? Why is this happening? You know, why is it the stock market's going up and the Fed's printed this QE and there's no effect in the economy, no benefit, you know? Why aren't these policies working? Should we base our entire country's economic policy merely on making the stock market go up? Or should we really try to build a real economy based on jobs and exports and production and producing things?
We'll have more with Mike Swanson right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Mike Swanson from WallStreetWindow.com. Mike, right now people are wondering what to do with their money. They're being told over and over again the stock market is overinvested. It's going to take a dump pretty soon, or likely, of course, we've heard that for 2 years. Where should they be putting their money? Should they just hold on to their cash and then wait until this thing bottoms out?
Well, very few people, if I were to say just sell out of everything and just wait, I don't think anyone's going to really listen to that type of advice, because in the end, people are more scared of missing out than they are losing money, missing out on the possibility of more market gains. So my suggestion to people would be just to sell maybe 10% and have a 10% cash reserve position that you can use on a correction or a bear market and do some buying with that. And if you can do that, then you, of course, lose a little bit less when things drop, but it'll be quicker to make the money back up because, you'll be able to buy in cheaper with some of your money. The other thing I would suggest is that people have a position in gold, a 10% position in precious metals. The reason why is because it's really, there's another dangerous market, really more dangerous than the stock market, frankly, and that's the bond market. Historically, the bond market tends to go up when the stock market declines because it trades opposite interest rates, and when the stock market declines, the Fed can cut rates and do stuff like that. But we're on a whole different ball game than has been in the financial market since the late 70s, because we're in a situation where the bond market is a bubble, and it's going to go into a bear market at some point. I don't know when. I don't know if it's going to be in a couple months or a couple years, but that's a very dangerous thing. And because when that happens, interest rates will go up without necessarily the willingness of the Fed for that to happen. But what will happen in that sort of situation is gold will go up in value if the bond market goes into a bear market. So it sort of can act as an insurance policy for your brokerage account. And even if all this stuff doesn't happen, it's likely just to go up anyway at some point. Gold had a bear market in 2011, and it's forming what I call a stage 1 base, which acts as a transition into a new bull market. It's basically going sideways between around 1140 an ounce and 1240 an ounce right now. But if it goes through 1300, it will go through all resistance and really be into a new bull market. Now, I don't know exactly, I can't predict when that's going to happen, but it's going to happen for whatever reason. So gold is something that can go up, even if nothing bad happens, it'll probably just go up. And if something bad does happen, then people will be very thankful to own it. So my suggestion is, sell a little bit and buy some gold too. So a 10% reserve position in cash and a 10% position in gold, and the rest 80% in whatever these people want to do is fine. But I would advocate though to get out of bonds. If you don't want to sell your stocks, okay, but get out of these bonds because there's no upside. There's no sense in owning, U.S. Treasury bonds that yield less than 2% over the next 10 years. At some point, think those are going to go down in value. Even if you are bullish, you believe we're on the boom coming and all this, the interest rates will still go up, just because of that. So the bonds are the things people really need to be more scared of even than the stock market.
Mike, how can people subscribe to your newsletter?
Thanks for asking. Just go to my website, wallstreetwindow.com. It's all one word, wallstreetwindow.com.
Thanks a lot for being with us.
Thank you.
My guest has been Mike Swanson from wallstreetwindow.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our very popular YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.